when stability became the greatest risk. For years, nothing seemed wrong. Prices moved smoothly. Volatility stayed low. Confidence felt permanent. The system looked calm, controlled, and resilient, until that very stability became the danger no one wanted to acknowledge. This story matters now because markets rarely break during chaos. They break after long periods of comfort. When stability lasts too long, it reshapes behavior, dulls caution, and teaches participants to assume tomorrow will look exactly like today. To understand how safety itself became a threat, we need to return to the moment calm stopped being a signal of strength. It began after a crisis that had scarred an entire generation of investors. The response was decisive. Safeguards were built, policies reinforced, liquidity flooded the system to prevent another collapse. Over time, those measures worked. Markets stabilized, shocks were absorbed, recoveries came faster. Each intervention reinforced the belief that instability had been conquered. The early reveal came quietly. Risk premiums compressed across assets. Investors demanded less compensation for uncertainty. Yield became scarce, pushing capital further out on the risk curve. Strategies once considered aggressive became standard. Leverage felt manageable because volatility stayed low. Stability started changing incentives. Institutions adjusted models to reflect calmer conditions. Households borrowed confidently. Corporations optimized balance sheets for efficiency, not resilience. Every decision assumed the same backdrop: smooth markets, predictable reactions, reliable support if stress appeared. Nothing seemed reckless. Everything made sense in isolation. But stability was no longer just an outcome. It was an assumption. And once an entire system is built on the belief that calm will continue, even a small disturbance can expose how fragile that belief has become. The market wasn't preparing for risk anymore. It was preparing for its absence. And that shift would soon test how dangerous comfort can be. As calm persisted, its influence deepened. Investors stopped asking whether risks existed and started asking where to find returns. The answer was always the same: take a little more risk, just a bit further out than last time. Each step felt reasonable. Together, they transformed the landscape. The reveal sharpened as volatility itself became a tradable signal. Low swings encouraged leverage. Leverage suppressed swings further. The cycle reinforced itself, teaching markets that smoothness was normal. Risk models reflected this new reality, adjusting thresholds downward, shrinking buffers in the name of efficiency. The early conflict emerged when rare spikes in volatility began causing outsized reactions. What should have been minor tremors triggered defensive responses across funds. Positions were reduced not because fundamentals changed, but because models demanded it. Stability had trained the system to react violently to deviation. Institutions leaned harder on protection strategies designed for quiet markets. They worked until they didn't. When too many players relied on the same hedges, protection itself became a source of stress. Selling begot selling. Insurance amplified damage instead of limiting it. Yet outward calm returned quickly. Intervention smoothed the disruption. Confidence was restored. The lesson drawn was not caution, but validation. Each rescue reinforced the belief that stability would always be defended. The system learned the wrong lesson, and learned it well. Over time, fragility deepened. Risk concentrated. Diversity faded. Behavior synchronized. Calm was no longer a natural outcome of balance. It was an engineered state that required constant reinforcement. And that reinforcement carried a cost. Because the longer stability lasts, the more painful its interruption becomes. The market had grown strong and calm, but weak against surprise. And the surprise was already forming, not as a shock, but as an inevitable moment when stability could no longer hold itself together. The buildup reached its breaking tension when the market encountered something it hadn't practiced handling in years: uncertainty without immediate reassurance. A data release missed expectations. Not severely, not disastrously, just enough to introduce doubt without demanding intervention. The reaction was disproportionate. Volatility spiked sharply. Protection strategies activated simultaneously. Funds sold to rebalance risk, not because they believed in collapse, but because their models required it. Liquidity pulled back as market makers reassessed exposure. The smooth surface cracked, revealing how much motion was happening beneath it. The conflict intensified as feedback loops took over. Rising volatility forced deleveraging. Deleveraging increased price movement. Price movement triggered more protection. The system wasn't panicking. It was executing exactly as designed. Stability had conditioned it to respond aggressively to deviation. What shocked participants wasn't the move itself, but the speed. Markets that once absorbed shocks now magnified them. Correlations jumped. Assets that should have diversified risk moved together. Hedges failed. The assumption of independence collapsed in real time. Institutions scrambled to interpret what they were seeing. There was no obvious villain, no reckless speculation, no hidden fraud, just a system that had grown intolerant of uncertainty. Years of calm had compressed resilience, replacing adaptability with automation. As selling accelerated, confidence fractured. Investors who had never experienced sustained volatility reacted emotionally. Stop losses triggered. Margin requirements rose. Forced selling appeared, not at the fringes, but at the core of the market. This wasn't a crisis born of fear. It was a crisis born of comfort. Stability had not prepared the system for disorder. It had trained it to amplify it. And as the market lurched from smooth to violent in a matter of days, one realization spread quietly through trading floors worldwide. The greatest risk wasn't leverage. It was a belief that nothing would ever disturb the calm. The climax arrived when the market finally understood what it was facing. There was no single crash point, no defining headline, just a realization spreading through screens and balance sheets alike. Stability itself had become the system's weakest link. As volatility persisted, support mechanisms lost their calming effect. Interventions that once reassured now triggered suspicion. Each attempt to smooth the market reminded participants how dependent calm had become on constant reinforcement. Confidence didn't collapse. It eroded slowly and unevenly. The resolution unfolded through adaptation, not rescue. Leverage was reduced. Risk models were rewritten. Strategies built for endless calm were abandoned or redesigned. The market relearned how to live with uncertainty instead of suppressing it. Volatility stopped being the enemy and became information again. Over time, balance returned. But it was different, less efficient, less smooth, more resilient. The illusion that stability could be engineered permanently faded, replaced by a harder truth. Markets need friction to survive. They need variation. They need discomfort. Modern relevance is unavoidable. Today's systems are still shaped by long stretches of calm, still tempted to treat stability as safety, still vulnerable to the moment when quiet conditions suddenly change character. The story wasn't about a failure of policy or intelligence. It was about a failure of expectation. Because when stability lasts too long, it stops being protection. It becomes risk. So what do you think? Are we repeating the same mistake again? When